Right, I'm going to describe an investment strategy to you. And when I tell you what it is, you're gonna think I'm taking the mick. Here it is. You pick an amount of money, any amount. Could be $50, could be $500. You invest on the same day, every single month, into the same thing, regardless of what's going on in the market. That's it. That's the whole strategy. No research, no trying to guess where the market is going, no watching charts at midnight, just same amount, same day, every month, done. That strategy, called dollar cost averaging, has outperformed the vast majority of active investors over the long term, and most people have never heard of it. Let's talk about why it works. I'm Leo, welcome back to Financially Fit Millennial, where we make this stuff simple, honest, and hopefully useful. If you're new here, glad you found us. If you're returning, what a legend. Today we're covering dollar cost averaging, one of the most powerful and most underrated investment strategies out there. And I say underrated because it sounds almost too simple to work, which is exactly why most people dismiss it and exactly why it works. And we're going to cover what it actually is, why the math behind it is so clever, how it stacks up against trying to time the market, and how to set it up so you literally never have to think about it ever again. Let's go. Okay. So let me actually explain what dollar cost averaging is, because the name sounds more complicated than it is. Dollar cost averaging, or DCA, if you want to sound like you know what you're talking about at parties, is simply the practice of investing a fixed amount of money at regular intervals, regardless of what the market is doing at that moment. So instead of trying to figure out the perfect time to invest, which, spoiler alert, nobody can do consistently, you just invest on autopilot. Every month, same day, same amount. Market up, you invest. Market down, you invest. Market doing something weird and sideways, you invest. And here's the beautiful mechanical thing that happens when you do this. When the market is up, when prices are high, your fixed amount buys fewer units. When the market is down, when prices are low, your fixed amount buys more units. You automatically buy more when things are cheap and less when things are expensive, without thinking about it, without doing anything. Think about it like you're doing your weekly shop. If chicken is expensive this week, you'll probably buy a bit less. If it's on sale, you stock up. You naturally buy more when it's cheap. Dollar cost averaging does exactly the same thing with your investments, automatically. The result of all of this is that over time, your average cost per unit tends to be lower than if you just dumped all of your money in at one random point. You've been smoothing your entry price across many different market conditions rather than betting everything on that one moment. Now here's the thing, the math of DCA is solid, but honestly, the reason it outperforms most people isn't just about buying a lower average price, it's about something far more important. It removes you from the equation. Let me explain what I mean by that. The single biggest threat to your investment return isn't market crashes, isn't bad companies or global recessions. It's you. It's me. It's every human being with a brokerage account and access to financial news. We are absolutely terrible at this. Studies consistently show that the average investor significantly underperforms the average market return. Not because they picked bad funds, but because they made bad timing decisions. They got scared and sold at the bottom. They got excited and bought at the top. They saw a headline that said market crashes and panicked. They saw a headline that said bull run incoming and piled in just before the correction. That gap between what the market returned and what the average investor actually got is enormous, and it's almost entirely explained by emotional decision making. Dollar cost average is the antidote to that, because you're not making a decision every month. You made one decision to invest a fixed amount regularly, and then you just let it run. The market goes down 15%, doesn't matter. Your direct debit goes out on the 5th of the month and buys whatever it buys. No decision required, no emotional trigger. And that's really powerful, because the worst investment decisions almost always happen in the moments when you feel most compelled to do something. DCA takes that moment away, and it turns out that's exactly what most people need. Now, there is a reasonable counter argument to dollar cost averaging, and I want to address it properly rather than just ignoring it, because I think you deserve the full picture. The argument goes like this: if markets generally go up over time, then investing everything at once, a lump sum, means your money is working for you from day one. If you spread it out over 12 months using DCA, the money you haven't invested yet is sitting in cash, earning less than it would be if it was already in the market. And mathematically, that argument is actually correct. Studies, including a well-known one from Vanguard, have found that lump sum investing outperforms dollar cost averaging roughly 2/3 of the time over a 12-month period, because markets go up more often than they go down. So why would you ever choose DCA over lump sum? 3 reasons. First, most people don't have a lump sum. They have income that arrives monthly. DCA isn't a second best strategy for people without a lump sum. It's the only practical strategy for most people. You earn money, you invest a portion of it, repeat. Second, the risk of being wrong about time the market is asymmetric. If you dump a lump sum in the market and it immediately drops 30%, the psychological damage and the financial damage if you panic sell can be devastating. DCA limits that downside. Third, and I keep coming back to this, most people can't psychologically handle a lump sum approach. Even if it's mathematically superior in expectation, if it causes you to lose sleep, make panic decisions, or abandon the entire strategy, it's not superior for you. The best strategy is the one you actually stick with. And for the vast majority of people investing from monthly income, dollar cost averaging isn't a compromise. It's the right tool for the job. Right, let me show you the actual math of how dollar cost averaging lowers your average cost, because once you see it, the penny drops. Let's say you invest $200 a month into an index fund. Simple scenario, 3 months. Month 1, the price per unit is $20. Your $200 buys you 10 units. Month 2, market dips. Price drops to $10 per unit. Your $200 now buys 20 units. Month 3, markets recover. Price is back to $20. Your $200 buys 10 units again. Total invested, $600. Total units, 40. Average cost per unit, $15. But the current price is $20. So your 40 units are worth $800. You've invested $600 and it's already worth $800, even though the market went down in month 2 and just recovered back where it started. That's the power of it. You bought more units when the price was low, which dragged your average cost down. So when the market recovered to its starting price, you were already in profit. A lump sum investor who put $600 in on day 1 at $20 per unit would have 30 units worth $600. Same starting point, same ending price, but significantly worse outcome because they couldn't take the advantage of the dip. Markets are volatile. DCA turns that volatility from an enemy into something that works in your favor. Okay, enough theory. Here's how you actually set this up, because it's relatively straightforward and most people massively overthink it. Step 1, pick your amount. It doesn't have to be impressive. $50 a month is fine, $100 is fine, whatever you can commit to consistently without it causing stress. The consistency matters far more than the size, especially to start with. Step 2, pick your investment. For most people doing DCA, a broad global index fund or an S&P 500 ETF is the obvious choice. Low fees, instant diversification, historically strong returns. Step 3, automate it. This is the crucial bit. Set up a regular automatic investment on a fixed date each month. Ideally the day after your salary lands, so the money moves out before you have a chance to spend it. Most brokerage platforms let you do this in about 3 minutes. Once it's set up, you don't touch it, you don't think about it, it just runs. Step 4, ignore the noise. Once your DCA is running, the single best thing you can do is not watch it obsessively. Check it quarterly if you want, but resist the urge to tinker every time there's a headline. The whole point is that you've removed the decision making. Let it do its thing. Dollar cost averaging. Same amount, same day, every month, regardless of what the market is doing. That's it. It works because it removes the worst investor in the world from the equation, which, with all due respect, might be you and me. It's not glamorous, it's not exciting, you won't have any great stories to tell about it, but over 10, 20, 30 years, it quietly and consistently builds wealth in a way that trying to be clever almost never does. If you want to see what your DCA contributions could grow to over time, go plug in your numbers into the calculator at financiallyfitmillennial.com. Same calculator we've used in the compound interest video. If you saw that, it's free, takes 2 minutes, link in the description. Subscribe if you haven't already, drop a comment below. Are you already doing DCA or is this something you're gonna set up this week? All right, legends, see you in the next one.